Hello, everyone. Welcome to this week's episode of Free Lunch. It is an honor to be hosting you for this week. My name is Kim Karaoke, and I'm joined by the one and only Mr. Kennedy Ken Gishinga. Ken, say hi to everyone and let us know how you've been doing.
Hi, Hi everybody. Great to be here today. A warm afternoon here in Nairobi, and such a great pleasure to be with the team today to really be able to discuss what's been happening this week.
Excellent, excellent. And Ken, how was your week last week? What did you do? Did you do anything interesting or fun?
Oh well, with these current restrictions, really there isn't much movement
Yes.
that's possible. So besides just reading interesting articles and watching interesting clips, really that's been my week. How about yours?
Very good. Mine has also been fairly slow. I think it got a bit of a rattling yesterday when the president announced a few changes to the current status quo. So really happy and excited to see the relaxation of some of the rules and consideration of some of the harsher conditions that were in play. So yes, like you, trying to keep safe, stay home, social distance, and be productive. So Ken, what are we talking
Excellent.
about? What are we talking about today?
Well, today we're gonna dive into the interesting topic of pension. And Kim,
Mhm.
pension is that amount that you receive almost towards the end of your career after a lifelong of working hard and really building your career and your country. And I think it's quite fitting, obviously, as we try and come towards the end of this season, we really look at what pension, that final amount, really how that sector has been impacted from various perspectives. Number one, obviously, the COVID situation has disproportionately affected people who are over 60, people who really on the verge of retiring. The question is, are we ready as a country to be able to pay these pensions? Number two is really the issue of a big part of our civil service. The average age of our civil service is about 46 years,
Yeah.
and a big chunk of our civil service will be retiring in the next 10 years. Again, are we as a country, are we ready to sustain the pension requirements that will be needed? And maybe finally, really
Mm.
to look at um, the savings culture among young people. Right now, a lot of companies have stopped remitting pension amounts
Mm-hmm.
to be able to sort of like cope with the COVID scenario. There's also been proposals on taxing or pension funds. So, where is our savings culture going to be really moving forward post COVID? What's your take on any of these three areas?
No, very good areas, and thank you for teeing it off. I think, on the one hand, you're very right. I think the problems are hitting us on multiple fronts, and it's also probably very helpful to distinguish between the issues. So there's the one side, there's private pensions. So what you and I would contribute through a pension provider and have that locked away as our own pension contribution. Then and even with that, I totally hear you on the pieces that you're talking about, where individuals have lost jobs, so they're unable to continue remitting. Companies may also be unable to remit because of COVID, and also generally our culture is generally low. So when it comes to savings, so it's not necessarily top of mind for people to save for the future. I think we're too present biased for very good reasons. And part of that also just not only COVID, but also just generally the economic hardships of Kenyans. But I think the other side of pensions is on the public side. So you're absolutely right that some of these challenges are cross-cutting. But a unique thing about the pension on the public side is that ideally the design of these things is that the person retiring tomorrow is being paid for by the person who's working today. So my contribution for pension today is helping somebody else retire tomorrow. And it's a very nice social safety net when it works, and really requires a one-to-one, near at least an ideally one-to-one ratio between the person retiring and the person contributing. And of course, if the ratio is skewed, you would hope that the interest rate will cover any anomalies. But then you have a scenario in the developing world and in Kenya as well, where there are bulges. So one challenge might be you have more people retiring. In some developed countries, you have more people retiring than people who are working. So then that creates a challenge. In Kenya, I would also imagine we have a bit of that, but probably for very different dynamics. With the higher level of unemployment here, coupled with that low savings culture, it's very unclear who is going to, if we have enough people working today to pay for the people retiring tomorrow. And then making that worse is the fact that when we are ready to retire, who is going to pay for our retirement because of these systematic and this systemic market failure issues within how pensions should work. So I sort of see the issue from both sides, and I think there's something that we can do to encourage companies and individuals to save more for their own private pension. But I think broadly the issue of pensions from a public perspective, we can't get away from some of those population bulge and unemployment issues that are clouding the matter when it comes to pension contributions.
And Kim, you've raised a very important dichotomy of differentiating between the public and the private sector. In fact, one of the developments in the public sector is, I believe from January next year, civil servants will have to part with about 7.5% of their income going into pension funds. It's as if the public sector now will be following the model that's used in the private sector, where there are deductions in the salary. And I think that was a new development. And I think that will be quite profound in terms of, I think the idea is to try and make it as stable as possible, given the limitations of the day. I'd also like to be able to, divide this discussion into two parts. The first part is really the part of collecting, raising these funds. And the second part is sort of like how these funds are spent, and I think there's some important conversation. When you talk about raising the funds, it's about, the state of the economy. Do people have jobs? Do you have enough young working people creating wealth for that to be taxed? And then there's a part of this huge, giant pool of money, where is it going to be spent? Right now, stocks are down, real estate has been oversaturated. Where does this giant pool of pension money, where is it going to be invested? So I think those are the two very important pillars of the conversation. And maybe we can start with the first one about raising the pension money. And I've said the government plans to follow the private sector way in terms to be able to, and I think it works well in countries such as Kenya, where the demographics are really in favor of the youth. And you have a lot of young people who will be entering the workforce. But when you look at countries like Japan, Japan has the largest pension fund in the world. It's an aging society. It's an aging society, and it's the dynamics, the demographics are slightly a bit different. So I think Kenya, the demographics are in our favor, but the question is, do we have enough yes, we have the population, but are these people in active employment to be able to generate that wealth, in your opinion?
That's the quintessential problem. And I think, even if I like the idea of following a private sector model, it'll be great to be able to know, okay, I contributed 10 million to a public pension scheme in the course of my employment. And so I am entitled to drawing that down over the course of my retirement. I think it would be helpful, but I think still on the public side of things, somebody has to pay for that now. the money that I'm going to get in X number of years is my money that I've contributed, yes, plus interest. That's what I'm entitled to. But that money has already been spent because I was paying for the people as I was working who were retiring then. So I guess I'd be curious to see if, as we pivot to this private sector model, it's going to work out well in the favor of people retiring. But then, there's also a point where you've talked about, to have a proper public pension scheme with all the different interests and actors in there, you really do need very clear and solid guidelines, strategies, platforms, policies to make sure that there's very good clarity on, for example, what is the pension investing in, what is the pension not investing in. And right now there's a lot of opacity in that, right? So somebody wouldn't know, like, what is the national insurance pension plan investing in, because that also provides another complication in that if they invest in junk bonds, or if they invest in investments that might be unnecessarily risky or that are not quite clear to the pension administration team, those pensions could run into trouble. So I remember the global financial crash, a number of pensions had invested in these collateralized debt obligations and other sorts of securities that were AAA secured and guaranteed, or at least certified to be of good quality and supported by the major rating agencies, only for them to collapse in spectacular fashion. So I think there's also, and that just also helps to underscore the point that if you don't have strong enough regulation and good enough opacity on what the pension is investing in, you could run your pensioners and your country into jeopardy sort of down the road.
Kim, I'm very glad you introduced the American experience during the early 2000s, and I think that was a very profound period because that around that same time, the Federal Reserve had really reduced interest rates to almost zero. Yet you have all these fund managers who demand some returns, and we saw a lot of money going into real estate. And in fact, that's what really fed real estate till the bubble burst in 2007, 2008. When I think of Kenya, the vast, overwhelming area where pension money goes to is in government securities, especially long-term bonds. Number two, that's pretty much commercial government paper is by far. I think, in fact, pension funds are only number two to commercial banks in terms of subscription to government security, and you feel like that's huge. And I guess it, in a sense, is also part of it is in real estate. A lot of big housing projects are run on real estate. My very apartment here is run by a pension fund. And right now we are seeing a major saturation in office space, residential space, to the point where there's so much empty space. Yet again, it goes back to what in one NPR episode they talked about, the giant pool of money that needs returns, needs that alpha. So it's a very tricky time to be a fund manager because you owe it to your benefactors to be able to provide return. But in an economy where the economy is depressed, there is really not much happening. You almost entirely put your money in government securities, and you wonder, is there a risk when you have such a big chunk of your money in government securities?
Indeed. And with governments, I'm just piggybacking off that point, as governments are reporting difficult financial times, a few governments have started talking about going into recession. You even wonder, it sort of places even more pressure on fund managers, because then you start wondering, is a government security that should be low risk, should be a low risk instrument and high guarantee of paying back, how robust are those, especially post crisis, right? Would investments sort of go away or lose value because a country is unable to honor its external debts? And then what does that mean for pensions, etc. So in fact, as you were speaking about the challenges that fund managers have, it reminds me of my earlier days when I was still when I was a lot more closer to the banking sector than I am now. I was always quite amazed how fund managers from European and EU countries would come and essentially offer microfinance institutions subsidized loans, or at least subsidized capital to lend. And these were part and part of their quote unquote green loans. And if you investigated further, the proceeds from those loans were going to help pensioners retire. So at a time when a microfinance institution would struggle to borrow money in the local market at 14%, they could access a loan from a fund manager sitting in the EU somewhere at 7 to 8% and pay a return of even 15%. And that's much, much better than the 9.5% that the European countries could be able to afford, for example. So then you'd find there was a lot of demand and interest in those types of loans. But then I always sort of felt bad because it was quite clear to the pensioner wouldn't know where their money is being invested. All they know is they're getting a good return and they're happy. But it's probably at the sweat of somebody really struggling to repay that loan.
Wow, that's quite fascinating, because that's where the numbers really come in, because it's really about returns. You really have to get the math right. And I think that's why some of the best mathematicians are in that space as actuaries. And I remember when when I was in high school, going into campus, one of the hottest professions then you could get into would be an actuarial scientist. Those were supposed to be the best mathematicians in the house. But sadly, almost 20 years later, I don't find many of them sort of moved into the depths of that space. In fact, many of them moved into other sectors of the industry. It just brings me back, even in terms of our skills and competencies perspective, even as a government, do we have a grip? Do we have a better model? Do we have a very strong modeling in terms of scenarios when we are being told almost half the civil service will retire in the next 10 years? Are we getting the mathematics right? Because it's a very scary prospect when people retire, and it happens in Kenya, and they can't access their pension for almost 10, 15. Others, people even die before being able to get some of their pension money. So it's one of those areas that requires a very sharp modeling skills.
Correct. And I think it also requires an in-depth understanding of what are the microdynamic conditions in each of the markets that you're investing in, and for the products that you're developing, for the client types that you have in mind, which of course now in a period and an economy of crisis where everything's uncertain, that certainly doesn't help simplify the issues on the table.
It doesn't. Now, one of the things that I mentioned a bit earlier on, Kim, was a lot of companies have chosen not to deduct the pension money or to remit right now because of the COVID situation. What's your, in the sense that I guess could be a stimulus.
Right.
What's your thinking on that?
It's tricky, and I think I'll answer that with another scenario that's happening where people are actually going back to their pension companies or even long-term policies and trying to talk to fund managers to see if they can access some of that liquidity to handle and go through the tough times. I think ultimately we're in uncharted waters, and it's tricky. I can see the huge need for it. And it's probably a point where there needs to be some discussions with the regulator and policymakers to think about is there bandwidth at all in any capacity under certain circumstances for people not to necessarily even draw out their savings, but maybe get uh, some advance based on what they've already saved? Because we're in such dire times that it feels like there's need for that stimulus, especially if you've lost your job, you've been sitting at home, with companies also struggling to meet payroll and other things. I think it's certainly a point where regulation needs to come up and jump out more strongly. And I'm keen to see if the IRA issues any guidance on issues around sort of long-term savings and accessing. I know if you have a long-term policy, for some types of policies, you can cash out early. It's not, of course, easy to do, but there's some huge punitive measures if you do so. But with companies having to divert funds and maybe even to meet payroll and to honor other obligations, I guess I hope and I pray that it's a once-off instance, just because of the crisis. But it definitely does raise a whole bunch of challenges. And then where does it stop, right? So if a company does it now, what stops them from doing it 5 years later, 5 months later, next week when we're out of the crisis, or when there's another problem? What are your thoughts, Ken?
You've raised a very powerful point, and I remember following Chile on this particular topic, where they passed a legislation when during the COVID peak, where people could access part of their pension. I think it was about 50% of their pension, be able to cope with this particular period. And I remember asking one fund manager here in Nairobi whether we could follow such a thing, because people would have a bit of liquidity to be able to meet their weekly obligations.
Yeah.
And he told me that might sort of like cut off the deposits that are badly needed, for example, in banking sector, in investments. And it almost put this whole question on two lines. Is it about the pensioner, the life of the pensioner, which was the one argument, or is it about the state of the industry, where people have to make profits?
Exactly.
And it was quite difficult, because those funds that are collected, they are deposits that are put in various spaces of investments or in deposits which are lent out. So as you try to help people here access their money, you almost sort of like crying out this pool of money that could have been used. So it's a very tricky space, and I know we don't have much time right now, but for me, I really feel looking at what countries like in the UK have done, where they have what they call RegTech, regulatory technology, coming in and being able to look at pension money and being able to model. I think it's a space for very disruptive innovation. And the UK has part of the fintech community in the UK is really in technology, looking at solutions for pension funds. And I think maybe that's one of the areas we really need to, as we talk about, when you talk about fintech in Kenya, we talk about digital lending, but fintech is such a broad space. And areas such as pension management is a place where fintech can really, really be able, where even right now in real time, you can be able to see how your pension money is being put to use.
Yeah, correct. But I'll tell you what, I like the idea of going a private sector approach. It reminds me of something I saw in the dailies a couple of days back, with Zamara being called in to manage Malawi's public service pension fund, which I think is great. I think it's good that the private sector can sort of start stepping up and showing leadership in how funds are administered and managed, and providing different ways of remitting funds into the public pension. Because those are some of the things they're going to be doing, is trying to bring in innovation and yet simple pension solutions for the masses. Though I also slightly worry about that, because at least in my mind, maybe it's how I was educated, but I feel like a pension is a social contract between the people and its government. So it feels like if a private sector is taking it on, the private sector incentives might skew the investment approach and may also create other complications that make it harder for this pension to be a universal cover for people at old age.
Oh, wow, that's a very powerful observation. Maybe as a bit of a segue, I just wanted to know, how has season one of Free Lunch been for you?
Season one has been good. It's been great having these conversations. It always feels like we end them right when the issue is becoming warm. But it's been good also to hear from from what others are saying. I've really enjoyed getting the perspectives when we've had a chance to speak with people on the street, as it were, to ground some of our observations and our thinking. How about for you?
No, definitely. And I think in our next season, definitely getting some of those more pedestrian views will also be useful. I think for me, it's also
Mm,
been a very insightful place to be in terms of really reflecting on how big macro issues still have this micro element.
mm,
Big macro topics still have big impacts in our daily livelihoods. Even if you talk about what you talked about education
mm,
back then. I remember one teacher calling me and she told me that was such a powerful conversation, how we were able to really,
mm,
look at, for example, the 844 system. And she found your view particularly profound, where
mm,
you posed the question, when you think about 844 sector, has it
mm,
achieved what it was meant to achieve?
mm.
And the question was, yes, it has what it was meant to achieve, it has, but whether that is a useful goal today is a
Yes.
whole different conversation. And she said that was such a profound view, which she had not had from before. So I think it's things
Mm.
like that that sort of like get me very excited.
Oh, fantastic. No, that's a very interesting observation and comment. And I think it's great that our listeners have been able to engage and are able to share with us like what they're liking, what's resonating, and what's different from the average conversation that's happening on the street.
Great. Well, I think in terms of my parting shot, I think for me, this has been a really insightful perspective, both today on the pension fund and the way forward, and really from a broader perspective of lunch, really having sort of economic thinking in our day-to-day lives, things that we take for granted, but things that have lifelong consequence. I think for me, it has been a real pleasure to be able to really unpack some of these things.
Same here. And I think for my parting shot, it's been a pleasure talking to you, Ken, every week, getting insights and feedback like you've shared, and also engaging with listeners and them, giving us inputs and feedback on what we should talk about, what things we should focus on. It's really been good to have these lunchtime conversations to sharpen our minds and sharpen our critical thinking on what's important and how we should be thinking about designing policies, products, programs to actually have an impact that we all so desperately want and need. So I think that's it for me. Happy and keen to receive any comments and feedback from our audience. And of course, happy to pick it up once we're back in the next season.
Absolutely. I think the ball is on the court of our audience. It's up to you now to give us some feedback. How would you like season two to look like? What would you like to see more? What would you like to see less? This is a time that we'll be refining it, and we really hope that this can be the premier conversation on the state of the economy.
Absolutely. Thank you, everyone. Thank you, Kenny G. Have yourselves a lovely rest of your day. And remember to take care, be safe, and practice social distancing.
Bye-bye.
Cheers, everyone. Bye.